In Common Stocks and Uncommon Profits, Philip Fisher makes an important point that past price ranges and past earnings per share figures have little or no relationship to the price at which a stock sells today, and therefore you shouldn't buy a stock based on those statistics alone. The problem is that when you buy stocks just based on past price ranges or just based on past earnings figures, you're emphasizing what doesn't matter and you're diverting your attention away from what does matter. So let's look at what does and does not matter in each case. Billy is looking at the highest and lowest price point that a stock has sold over the past 5 to 10 years and is going to use this information to come up with the price he's willing to pay for the stock. So what doesn't matter in this scenario? Well, unfortunately for Billy, the very thing he is looking at, the past price range, doesn't matter. Think about what a market price is. Paraphrasing Fisher, is basically a composite appraisal of the outlook for a company by all potential buyers and sellers. So what gets factored into the market price? Well, obviously the current conditions of the company, the opportunity cost of the investment, which leads us to how the company compares to other similar companies and the appraisals of those companies. Also, the future prospects of the company and how the prospects of a company fare against the prospects of its competitors. And finally, general economic conditions get factored into the market price insofar as they affect the outlook for a company or affect the general mood of the investing public. Notice what is not factored into the market price. Past market prices. Well, why not? Well, many major things could have changed, like new and better management or products. Here, people would be willing to buy into the company at higher prices, given these favorable changes. Or, on the flip side, maybe they replaced able managers with completely incompetent managers. People would now want to liquidate their holdings for fear that the new management would do things to the detriment of the company's well-being or act in conflict with shareholder interest. This would obviously drive the market price down. But basically, the information used to value a company today could be significantly different than the information used to value the company in the past. And that's obviously because of the potential changes that could have been made. Take Berkshire Hathaway, for example. It was once a financially insecure textile manufacturing company, and now it's one of the most reputable holding companies of all time. Granted, this change took place over a long period of time, but the information used to price Berkshire when it was a textile operation is completely irrelevant to the information that ought to be used to price the stock today, even though it's the same company, at least nominally. What does matter is whether there is anything going on in the company right now or in the near future that justifies importantly higher prices than those currently prevailing. And if that justification exists, then you should buy the stock because that sucker's going up. The next thing that doesn't matter is the earnings per share 4 or 10 years ago. When you look at that number only, when you look at the EPS alone, it's like looking at the output of a motor without examining what kind of motor it is or what the conditions were when the motor generated that output. Once you have an understanding of the motor or company and how it performs under certain conditions, then you can intelligently envision what will probably happen over the next several years. Imagine you heard that someone bench pressed 200 pounds. Not bad. But what if you learned it was a 100-pound 10-year-old kid with a broken arm? You'd be pretty impressed. Now that I've given this bench press story some context, these background conditions make you think about what would be possible as the kid grew up and was fully functioning. He'd probably be able to do a lot. Well, same with companies. The idea is that numbers don't mean anything in isolation. You have to give them context. Additionally, past earnings figures coupled with an understanding of the company and the conditions during a certain time period are only there to help foster an understanding of what is possible for the company in the future. In other words, you use the company's history to get a picture of the company's potential future. It's the next 5 years that matter. As Fisher says, it's the future, not the past, which governs. But there's an error we can make here. People often believe that whatever happens in the past for a number of years is bound to continue indefinitely. But the past does not entail the future. For example, people assume that a company with smooth earnings growth will continue. But think about two major things that contribute to growth. Well, the results of research and bringing new products to market. But the timing and costs of these is uncertain. And then there's the risk of the new product being not well received. Moreover, there's a huge uncertainty regarding whether the new product will be able to sell in a way that continues the current growth trend. If it's a product that requires higher production costs, then to continue the growth trend, it's got to make up for those costs by bringing in commensurately higher revenue. A lot of times, companies have 1 to 3 year dips in earnings for these reasons. So if you don't understand the company or its background conditions, then trading on earnings per share alone can be very costly. You might see consistent growth in earnings over the past 5 years, but that doesn't mean it's going to continue. And if you invest, you could suffer permanent capital loss. Or if you see a dip in earnings in the past, you could pass on the investment and subsequently miss out on a potentially great opportunity. And you could lose here in the sense of having missed that opportunity. Either way, knowing the company and its current conditions is critical for determining what you should do. There are a couple ways that looking at earnings per share and past prices can be helpful. First, looking at the earnings per share and stock price over a past period alongside a market index can reveal the cyclicality of a company, or how much the company's earnings and market price is affected by the business cycle. So, if you invest and you see things start to slow down, get out and move on to something else. Second, you can use the past price and earnings figure to determine a baseline earnings multiple, or PE ratio, for the company. But it's crucial that you understand the background conditions. If major changes in the background conditions occur, such as new management, updated R&D department, a completely new sales training program, a major acquisition, stuff like that, then the baseline that you just established will be useless. Before, the baseline might have been like an 8 or something like that under that set of conditions. But because new favorable changes occurred, for example, the baseline might become 15. Of course, when conditions change, as they inevitably will, the baseline must yet again be adjusted. So in summary, we looked at some stupid things to do, namely, make decisions based off a superficial analysis of past price ranges and past earning figures. And here's the general takeaways. First, don't be influenced by what doesn't matter. Second, you can't look at numbers in isolation. You have to give them context. Third, the past does not entail the future. Fourth, it's not about the past 5 or 10 years. It's all about the next 5 or 10 years. So if you feel a little more wise than you had when you started this video, please like the video, because that lets YouTube know this video is worth engaging with. Also, please join the hike and hit subscribe. If you don't feel a little wiser, hit the thumbs down button, or preferably leave a comment that will enlighten us all. Either way, thanks so much for watching.